There's a guy named Walter, 51 years old, responsible, the kind of person who reads the policy documents. 12 years ago, a financial advisor, who was also a licensed insurance agent, sat across from Walter at a kitchen table and explained that whole life insurance was not just protection for his family, it was a wealth-building vehicle, tax-advantaged growth, a cash value component that compounds over time, an asset he could borrow against, a death benefit his children would receive tax-free. Walter was a thorough person, so he asked questions. The advisor answered them well. Walter signed. He is paid $480 a month for 12 years, $69,120 total in premiums. His policy's cash value today is approximately $41,000. His death benefit is $500,000. Walter believes he has been building wealth while protecting his family simultaneously. He has not run the alternative calculation. Almost no one does, because the person who sold Walter the policy had a commission structure that made running that calculation financially inadvisable for them personally. If Walter had invested that same $480 monthly into a term life policy costing $47 a month and put the $433 difference into an S&P 500 index fund, his family would have had the same $500,000 death benefit for 12 years, and his investment account today would hold approximately $110,000. Walter has $41,000 in cash value. The gap is $69,000. Walter is 12 years into a 30-year product. Run the gap to the end of the policy, and the difference in outcome is not $69,000. It is transformative. And Walter has never seen that number, because the person who benefits from him not seeing it is the person who showed him every other number.
Here is what I want to walk through today. Whole life insurance and its variants, universal life, indexed universal life, variable universal life, is sold to millions of Americans using a framing that conflates two entirely separate financial functions, risk protection and wealth accumulation. The conflation is not accidental. It is the product design, and the product design serves the distributor's economics far more reliably than it serves the buyer's retirement. I'm going to show you exactly how the commission structure shapes what gets recommended and what does not. I'm going to show you the math that the policy illustration never includes, and I'm going to give you the framework for thinking about insurance and investing as the separate tools they are, because separating them, for most people, produces a dramatically better outcome than bundling them into a product that does both jobs adequately and neither job well. Start with a historical reference that makes the bundling logic visible. In the early 20th century, the company town was a common feature of American industrial life. A corporation owned the factory, the housing, the grocery store, the church, sometimes the school. Workers were paid in company scrip, currency valid only at company establishments. The arrangement was not overtly coercive. Workers got housing, food, and employment in a single integrated package. The problem was that the integration eliminated the workers' ability to shop for better prices, compare options, or direct spending toward their own preferences. The bundle served the company's interest in capturing the full economic output of its workforce. It served the workers' interest only to the extent that no alternatives existed. Whole life insurance is a financial company town. It bundles risk protection and savings into a single monthly premium paid to a single institution, eliminating your ability to buy each component from its most competitive provider, compare their true costs, or direct the savings portion toward the highest returning vehicle available to you. The bundle is convenient for the insurer's revenue model specifically.
Here is how the economics actually work. A whole life policy generates a commission for the selling agent of approximately 50 to 100% of the first year's premiums, depending on the insurer and the agent's contract. On Walter's $480 monthly premium, that is somewhere between $2,880 and $5,760 paid to the agent in year one alone, followed by trailing commissions of 5 to 10% annually for the life of the policy. A term life policy, which provides identical death benefit protection for a fixed period, generates a commission of roughly 30 to 50% of the first year's premium, with minimal trailing commissions.
On a $47 monthly term premium, the agent earns somewhere around $280 in year one. The commission differential between recommending whole life and recommending term plus investing the difference is approximately $2,600 to $5,500 in year one alone, plus the trailing commissions on decades of $480 monthly premiums versus trailing commissions on decades of $47 monthly premiums. The person sitting across the kitchen table from Walter is not making a neutral recommendation. They are operating inside an incentive structure that makes the whole life recommendation worth 10 to 20 times more to them personally than the term recommendation. This is not a conspiracy, it is a compensation design. But it is a compensation design that has produced a financial product holding trillions of dollars in American premiums that for the majority of buyers underperforms the separatist alternative by a margin that is not subtle. Now run the math that the policy illustration excludes. The policy illustration, the document your agent shows you when selling whole life, projects cash value growth using the insurer's internal rate of return, net of their costs and mortality charges, typically producing figures that look reasonable in isolation. What the illustration never shows is the same dollars compounded in an alternative vehicle. Here is how to run the comparison yourself. Take your total whole life premium. Subtract the cost of a comparable term policy for your age and health status, easily quoted online in 10 minutes, typically ranging from $20 to $80 monthly for a healthy person under 55 for a 20-year, $500,000 term policy. The remainder is your investment differential, the amount you would invest monthly in the alternative scenario. Compound that differential at 7% annual returns for the policy term. Compare to the projected cash value in the policy illustration at the same endpoint. In virtually every comparison for people under 55 in good health, the buy term and invest the difference strategy produces a larger accumulation by a margin that grows wider with each decade the policy runs. The specific numbers vary by age, health, and policy. The directional result is consistent enough that fee-only financial planners, advisors paid directly by clients rather than by product commissions, recommend whole life insurance for a genuine wealth-building purpose in a small minority of specific circumstances, and term plus index investing for the substantial majority. Here is the psychological mechanism that makes whole life such an effective sale despite the math. It is called loss aversion asymmetry, and it operates through the death benefit framing. When an agent presents whole life, the emotional anchor is the $500,000 your family receives if you die. That number is large, protective, and viscerally motivating. The $480 monthly premium feels justified by the protection of that outcome. The opportunity cost, the $433 monthly investment differential, and its compounded future value is abstract, future, and framed as what you would do with the money if you did not protect your family. The framing converts the investment comparison into a moral question about how much you value your family's security. Most people do not comparison shop on moral questions. They pay for certainty. The insurer prices that certainty at a premium that funds both the death benefit and the profit margin on the bundled savings vehicle, and the buyer's loss aversion does the rest of the sales work. So what does the person who runs the actual math do instead? 3 decisions. Decision 1. Separate the insurance function from the investment function completely and buy each from its most competitive provider. For risk protection, the actual job of insurance, term life is the correct instrument for the overwhelming majority of people between 25 and 60 who have dependents and income to protect. You need coverage for the period when dependents rely on your income. You do not need permanent death benefit if your goal is to accumulate enough invested assets that your death benefit becomes your portfolio, which is the actual long-term wealth goal. A 20 or 30-year level term policy provides exactly the protection window most families need at a fraction of the whole life premium, leaving the differential available for investment. For the investment function, building retirement wealth, low-cost index funds inside tax-advantaged accounts are the correct instrument. 401k to the employer match first, Roth IRA to the contribution limit second, taxable brokerage thereafter. These vehicles are not bundled with insurance costs, mortality charges, or agent commissions. They compound the full contribution at market returns.
That is their entire job, and they do it without the overhead embedded in the whole life structure.
Decision 2. If you currently own a whole life policy, run the comparison before surrendering it, because the calculus changes based on how long you have held it. The commission load and early surrender charges make whole life policies most expensive in the first several years. If you are in years 1 through 5, the case for surrendering and redirecting is typically strong. You have paid the highest cost period without accumulating meaningful cash value. If you are in years 10 through 20, calculate the internal rate of return on your specific policy to date compared to the investment alternative going forward and model the tax implications of surrendering. In some cases, particularly for older policyholders or those with health conditions that would make new term coverage expensive, the calculation shifts. The point is not that whole life is always wrong. The point is that the comparison should be run with actual numbers before any decision, and most people who own these policies have never run it. Decision 3. If an advisor recommends a whole life, indexed universal life, or variable universal life product, ask one question before any other. How are you compensated if I purchase this product versus if you recommend term and a separate investment account? The answer to that question tells you everything about the incentive structure shaping the recommendation. A fee-only fiduciary advisor, one who charges you directly and receives no product commissions, has no financial incentive to recommend one product over another. Their recommendation reflects the analysis. A commission-compensated advisor recommending whole life is not necessarily wrong, but the commission differential we described is real, it is large, and you deserve to understand it before you decide whether the recommendation is for your benefit or theirs. Ask the question. The response, including any discomfort the question produces, is informative. Here is where Walter is today. He has $41,000 in cash value in a policy he has paid $69,120 into over 12 years. He has 18 years remaining before retirement. He is not catastrophically damaged, but every month he continues paying $480 into that policy instead of $47 into term coverage and $433 into an index fund. The gap widens. Over the next 18 years, the compounding differential is not a rounding error. It is the difference between a retirement account that gives him choices and one that makes choices for him. Walter did not make a stupid decision. He made an uninformed one, guided by someone whose compensation structure pointed in a specific direction, using illustrations that showed his cash value and never showed the alternative. That is not unusual. It is the standard experience of millions of Americans who were sold a bundled product by someone who was paid to bundle it. The math is not complicated once you see it. The problem is that the person most likely to show it to you is the last person financially motivated to do so. Subscribe if this reframed a product you already own or were considering. Drop a comment with your current whole life premium and what that same amount, invested monthly at 7% from today to your retirement, would be worth. That number is the real policy value. Most people have never seen it next to the cash value projection. Now you can put them side by side.